Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Trading is being shaped by expectations of US economic resilience following the release of Friday's NFP data, which saw strong job gains and upward revisions to some past releases. This impressive figure, along with a lower unemployment rate, fueled a sharp rise in the dollar. The probabilities of a 50 basis point rate cut have now been ruled out, with markets shifting towards a 25 basis point cut or even the possibility of a no cut at all, further boosting the dollar strength and a climb in yields. Good morning, JK. You have been one of the few consistently maintaining the narrative of a potential dollar basing. How are you reading the markets now? Do you think the dollar has more room to move higher, or are we nearing the end of this rally?
Good morning, Swaraj. I think that needs some more evidence from US economy um, because if you look at the jobs data, there are different perspectives that can be taken. No doubt, the headline data was super strong with 254,000 new jobs created. Unemployment rate actually falling to 4.1%. It was 4.3% 2 months back. And so, the wages also increasing, which means there is a perception that US economy is not as weak as it was perceived to be earlier. And then there is chance that inflation is also rising. This changes the complete narrative from what Fed itself was pushing through earlier. But what we need to see is whether this is a sustainable improvement that we are seeing, because if you look at the details of the jobs report, there is concern that it is not as strong, because once again the gains majorly are in part-time jobs, and over the last 1 year the full-time jobs actually have seen a reduction. Secondly, there are indications that these numbers might have been boosted by seasonality factor, particularly in the hospitality industry. So we are not sure whether this increase in the jobs will be maintained. We should not be either saying that it is a soft number just because of these perspectives, but I think we need to see more evidence. If you look at many other indicators, particularly the surveys by ISM on manufacturing and the services side, employment index was actually down. That's another evidence that there is deep inside, there is some softness in the data which may reflect eventually. And don't forget that last year's number were eventually revised by a whopping 8 lakh jobs. So the reliability on the headline number is much less compared to earlier, but we have seen flashes of weakness in the US jobs market, which which according to me will keep the Fed on easing mode, definitely, but not as much as the market is discounting. They will go month by month accordingly. And November is definitely down to 0.25% from 0.5% earlier, as indicated by the Fed Watch tool also, which almost is negligible for a 0.5% cut, but 97% for 0.25 cut. In fact, one of the members of the Fed, Mr. Goolsbee, also indicated that they will not like to go by one number, and the Fed is not will not be right in maintaining the rates at the current restrictive level. That was a statement that he had made. Therefore, and I think I will take this data not fully at its face value, but I will wait more confirmation from more data coming up, particularly on the consumption. Yes, as of now, markets definitely reacted big, particularly in the bonds. Because the shift from 0.5% to 0.25% cut, you can entirely reflected in the 2-year yield, which went up by 22 basis points. That's a massive move in a year. sorry, in one day's data. However, uh, we also know that the yields were trading at 1 year lows, and there also we have been mentioning that there is very limited downside for the yields from these levels, having fully discounted the rate cuts up to end of next year. So that's the reason why the yields rallied, or rather the bond prices crashed. On the stocks, they celebrated the number with a lower probability of a 0.5% cut, obviously, and more conviction of soft landing by the economy. Port strike called off on Friday, and then of course the Chinese stocks that traded in US are also trading firmly. These added to the major indices in the US are going up. And on the currencies, the dollar index did rise 0.5%, but that is well short of the rally that you would expect for the kind of jobs report that we got. If you take it, on the headline basis, this is probably due to the fact that index has already recovered more than 2.25% from its lows over last 1 week. Also, the underlying bearishness in USD remains because the Fed will be staying on a rate cutting course with rates to be lower by another 1.25 to 1.5% by the end of next year. So the dollar's attractiveness due to high yield is definitely diminishing, maybe at a slower pace, but that keeps the dollar on a softer footing, at least on a medium-term basis. Yes, near term, it has a scope to rise some more, maybe another 0.5 to 1%, depending on how the Middle East war proceeds, how the oil price behaves. Maybe that gives some safe haven bid to the dollar, but it's very difficult to see euro breaking the 1.09 levels, or even GBP breaking the psychological 1.30. Dollar yen big resistance at 150 because of interest from exporters to sell at those levels, and also from investors who had been caught out when Japan hiked their rate. So we need to watch the data from other side as well, from Europe, after October 17th rate cut, whether they'll be cutting more, and what is the timing of the BOJ rate hike. So these are the things that will determine the dollars. But near time is dollar has some more scope to rise, but I think the underlying weakness of the dollar will emerge after some more evidence from other economies as well. Gold has a strong resistance at 2670 and may test the support at 2610, or slightly even lower, because of the huge move that we have seen. And again, the year-end factor may be coming into play because of profit taking by investors in some of the segments in the market, and that was majorly evident in the rupee, or rather the FI flow into the Indian market, which saw a massive outflow of nearly 5 billion from last day of September. And I think it's more than anything, it is widely believed to be a shift by some of the major FIs from Indian market, perceived to be overvalued, to the Chinese market, where the risk reward is much better. Now, having accumulated on the dip at 8350, the RBI is also now seeing its own reserves gone beyond 700 billion. I do not think they are letting the rupee fall further near term, unless there is an escalation in the war, and being a prolonged one, it leads to oil prices shooting above 85 per barrel, which has an implication for our current account deficit and inflation as well. So I think unless these conditions worsen, I do not see the rupee being let above 84. There were already indications that the central bank had intervened in the offshore market on Friday, when the rate traded above 84, and we are already seeing it below 84. I think it may not, unlikely that we see drift lower in the dollar rupee immediately, because the seasonal factors will keep it on the higher side. However, breaking above 84 will require a lot more than one set of data from US, or even in the current geopolitical situation, where it seems to be kind of restricted the Israel from further serious action, with the US and other allies trying to persuade them to take any further action. So it's a wait and watch what's happening there. And yes, the rupee looks like it will be steady in the range, but probably trades more towards the weaker end of the range, definitely. Yes, there is one more news that senior officials from China China's top economic planning agency will brief reporters tomorrow when the Chinese market opens after Golden Week holidays on steps to implement policies to promote economic growth. So something the market will look forward to. Today, once again, the Hong Kong market, which is a proxy for China, has rallied by 1%. So the risk is not that bad overall, with even Japan rallying by more than 2%. Yes, we look forward to more data and evidence from US economy and the war front to get further evidence on the trend in currencies. Thank you.
Thank you, JK. And just quickly summarizing from the job data perspective, as you mentioned, headline numbers have been strong with wages increasing. So what now needs to be observed is whether this will be sustainable. But one interesting thing is that the job gains have seen increase in part-time jobs, while full-time jobs have seen a reduction. And moreover, the gains have come due to seasonally influential industries like hospitality. So that's one thing which markets will be looking out for. The expectations of sharp rate cuts have moderated. The US two-year yield shot up by 22 basis points as investors shifted bets from a 50 basis point cut to 25 basis point cut. We also saw dollar index rising by 0.5%, and the index has actually recovered more than 2.25% from its lows. For rupee, there was some general weakness as there was consistent outflows from the Indian equity markets due to a potential shift in portfolios from the Indian equities to the Chinese equities, and of course, with the reserves now, the forex reserves are now exceeded $700 billion. It is expected that rupee is unlikely to break 84 at least in the short term. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.